Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network. Good for you. You're getting an education in economics and finance and investing. Americans need that, and I hope you'll share this video with other Americans who need it. But before you share it, subscribe right now to our YouTube channel and then share it with other people. All right, we're going to talk in this section about the supply chain crisis. That got a lot of news. It was very important. We talked about it a little bit in the last video, but really this is important enough that it's going to take a little bit more detail. All right, let's look at the data. This should look a little familiar to you because this is where we left off the last video. This is gross output. Gross output was invented by Mark Skousen, who's a colleague at Eagle. Gross output is the entire economy, including the supply chain. So what we've done at Bowyer Research, that's my team, we took that gross output and we took out final spending, and we took out government. So what's left is real private GDP change. So this is actually real private gross output minus real private GDP. Then it's the percent change, which amounts to business. The green is business. And we see over here back in 2020, the whole economy was growing faster than the supply chain. The supply chain was struggling to keep up. That gap right there was the struggling to keep up with the growing economy. As the COVID restrictions were gradually lifted, maybe a little too gradually, they were lifted and the economy was gradually opening up again. People were going out and spending again, and businesses, frankly, having a little trouble keeping up. And that caused a supply chain crisis. Then they kind of caught up a little bit. See, the supply chain growing a little faster than the economy, and then a little bit more of a gap, and then we have a situation where supply chain actually got out ahead, and that's why really by the end of last year the supply chain crisis was largely healed, not all the way healed, but not as panicky as some of the headlines, and people were saying there isn't going to be any Christmas this year. Well, there was a Christmas and people were able to mostly get the presents that they wanted. Okay, let me talk to you a little bit about something that will help explain this even better, which is inventory. We're not really going to understand what's going on with the economy, especially this weird COVID shutdown, COVID open up, COVID partial shutdown, partial open up, partial shutdown, and all the weird dynamics that we really haven't seen since World War II rationing laws, where we have suppression of demand, very odd economic circumstances. So it's a little confusing because when things are weird, they're a little harder to understand. But if we look at inventory, I think we'll get a clearer picture. So let's look at the data. Let's look at inventory. This is total business inventory, and above the line, most of them are above the line, is inventory growing. Below the line is inventory going down. Oh, it went down a lot during COVID because production decreased a lot. You see that? Look at that. And then it came back a lot. So you might think, oh, wow, we had a real inventory shortage here. Well, actually not. So we have to take a moment. Let me talk to you about this. We have to take a moment to talk about what inventory is for. Businesses are not in the business of creating inventory for its own sake. Businesses are in the business of creating inventory in order to sell. Now, of course, wholesale business, they create products to be inventory for somebody else, but they sell it to somebody else. And then that somebody else, a retailer, sells it to you. But there's no point to any of it unless eventually somebody buys it. That's called consumer sovereignty. All business production, all supply chain is for the purpose of serving you by selling you something. So what we need to do now is not just look at inventory by itself, but look at inventory relative or in relation to sales. Let's look at the data. So what we have here is inventory to sales ratio. So this is inventory divided by sales. And what you see is that generally, historically, there's about enough inventory is about 1.4 times the amount of sales. So businesses out a little ahead generally. They've got stuff that they're selling to you now, but they also have something for next month and the month after that. So they kind of keep that supply chain filled. And then what happens is during COVID, actually the inventory to sales ratio rises. Well, does that mean they were producing a lot more inventory? No, they're producing less inventory, but we were hardly buying at all. Basically, buying shut down. So at that point, business is still producing some stuff, but we're not really consuming it. And so they got out ahead and they got that huge margin. And then, hey, maybe you can go to the mall for a little while. And then what do? We spend down we spend, and that inventory goes down. Now they still have a nice margin. They still are able to keep up with our demand, and we keep spending, and they're producing. And remember, I said that around here we have this gapping. The supply chain is having trouble keeping up with demand. That's a gapping, and then a huge gapping here. Supply chain having trouble keeping up with demand. Business is trying to produce what we want, but we are out there finally unleashed from the COVID lockdowns, and we're out there buying, and they're having trouble keeping up with it. So this is probably this is one of the worst times in the supply chain, and this also a very bad time. Probably this is the very worst in the supply chain crisis. But then the margin gets better, and they get a little bit of margin and a little bit higher, and I think it's going to be a little bit higher after here. So what does that mean? It means that the supply chain crisis was foreseeable before it was in the headlines. It also means the supply chain crisis was a reflection of the weird economics of suppressed demand. The government generally doesn't suppress demand. Generally, government says spend, spend, spend. In this particular case, they said don't spend. Well, actually, they said here, stimulus checks, spend them. And then consumers said, spend them where? You're not allowing us to spend our stimulus checks. So I guess we found our way to e-commerce. But not everyone does e-commerce. And so what's happening here is when this inventory is building up, those are profits that are frozen. The actual economic value is being created, but the profits aren't showing up as profits. And when that's happening, eventually that gets unfrozen, and that shows up as profit. But then the demand is so much higher than supply that we get a crisis, and then the crisis starts to heal itself. So where does that leave us? Well, that leaves us with we could have another supply chain crisis. And a lot of people are concerned about it, but something would have to change. More shutdowns, say overseas in our supply chain, maybe another round of COVID, especially one that affects production. But as of now, the supply chain is doing what the market allows it to do, which is to adapt to situations and catch up with consumer demand. You may think inflation makes that worse, but actually inflation is a signal to business. People want stuff, go make more of it, build it and sell it while it's profitable to do so. So the market is actually healing itself. What does this mean for you as an investor? It means you have to take the long view and understand that a lot of the temporary fluctuations are about the weird dynamics of COVID economics and not about long-term investment propositions. So thank you for watching the Eagle Investing Network. Did you hit subscribe yet? If you haven't, hit subscribe now. If you have, then share this with somebody else because this is useful information for everybody. I'm Jerry Bowyer. Thanks for joining us.